I'm Matt Bichard here at the La Quinta Resort and Club in Palm Springs, California for REITwise 2017, NAREIT's Law, Accounting, and Finance Conference. Joining me today is Michelle Randall, tax partner and real estate thought leader with E&Y. Michelle, thanks so much for joining us today.
You're welcome. Thanks for having me.
Now, I'd like to start, what should REITs keep in mind about state taxes as Congress considers the broader federal tax reform?
Well, I think REITs really need to keep state taxes at the front of their mind. There's a lot of uncertainty right now, and I would say from a federal reform perspective, we're talking about generally, no matter what the plan is, having a broader tax base and lower federal rates. States really piggyback off of the federal tax system, but it's not as straightforward as that. We're going to have to monitor the federal reform and determine whether or not states are going to pick up all aspects of it. So we typically have a few situations for states when they adopt federal legislation. We have states that automatically conform. They have a rolling conformity date. And then we have some states that enact as of a specific date. And then other states where they may adopt certain provisions. So it's really a mixed bag as to where some of the states will go with this. I think the added complexity around REITs generally follow the federal rules for state purposes. It does add to some tax conformity issues that REITs should be worried about. For example, the states may not adopt all the federal tax base changes, and if they don't, for state purposes, your DPD deduction, your dividend pay deduction, for federal purposes may not cover your income tax for state purposes. So there could be tax leakage. The other thing we're seeing for the states is we really don't know where they're going to go with this. There's a lot of uncertainty and chaos. We have about 25 states that are in deficits right now, and quite frankly, this chaos isn't really adding to any positive news for them because they really don't know what their budgets are going to look like. So I would say there's a chance some states would completely potentially go away from the corporate tax regime and go to what we have seen in other states do, which is a gross receipts type tax. So I think there's a lot to think about. REITs in particular think about nonconformity issues, and that, for federal purposes, you may get the DPD, but if we have all these changes for federal, you need to think about state tax leakage and keep that at the top of your mind when the federal reform comes in.
Great. And federal legislation significantly changing the procedure for the IRS to conduct partnership audit goes into effect in 2018 and earlier if elected. How are states reacting to this legislation?
Well, I would say states have been really slow to react, and that's not necessarily a bad thing. The audit rules are really a federal procedure that is changing, and states have their own audit and collection procedures. So, this isn't something that I think states really should rush into. From a state standpoint, historically, states, while they don't tax partnerships, usually they're treated as pass-through, same as federal. They have what we call withholding taxes on the partnership itself. So states collect withholding tax on non-resident partners. So they're already used to having that as a mechanism where they can get tax from the partnership, as well as composite returns. So I think it's very complex from a state standpoint because of the way the partnership rules work. So states should probably take some caution and not automatically jump onto the federal provisions. And the last thing we would want is states adopting their own provisions around this without fully thinking it through, because it could get pretty complicated.
Now, we're seeing a lot of states enacting what's called market-based sourcing. Mm-hmm. Can you explain a little bit about what that is and what the impact is? From
a high level, it's really states using the apportionment formula to pull in taxpayers that are located outside the state but have customers within the state. So it's a way for them to pull more revenue in. What market sourcing really means is states apportion based on your activity, property, payroll, and sales. A lot of states are really just going to a sales factor. And so if they can argue to pull more intangible income into the state, such as interest from loans or fee income into the state, it increases their revenue base. So market-based sourcing is a way for intangible and service-based income to go to where customers are located rather than a company's headquarters where their employees are.
Michelle, thank you so much for joining us.
You're welcome. Thank you.
For more from REITwise 2017, be sure to visit NAREITsREIT.com.